Hello everyone, in this video we'll be talking about section 5.5 which is social cost of inflation. Now before starting, let us summarize what we learned in the previous video, which is MD is equal to P LIY, where we have seen the relationship of all these, right? We can conclude that MD is directly related to P, which means if money demand has increased, then prices will also increase. Second is money demand is directly related to Y, which is if money demand has increased, then your Y or income will also increase. And the third one is money demand is inversely related to I, or expected inflation plus real interest rate. Okay, which means, for example, your expected inflation rate is increasing, then current money demand will decrease, which means that if you are having 100 rupees and current inflation was 10%, your bank or economists of your country expected inflation rate for the coming year as 15%. So you know that if you hold this money right now, then you will have to pay inflation taxes, right? And it's going to be a bad deal for you to keep money with you. So you'll deposit it in your bank, right? At least you'll get some money and you'll not be required to pay the inflation taxes which is imposed on the money holders, right? Now this depositing in bank will decrease your current money demand, and this is how it's related. Okay, so this was it about the part that we learned in the previous video. So now we can proceed to our social costs of inflation. There are basically 5 types of social costs that we have to bear in case of inflation. Number 1 is shoe leather cost. Second is menu cost. Cost of not charging price. Tax distortion and inconvenience. Let's start with shoe leather cost. Well, you know, if inflation increases, your nominal interest rate will increase. Why? Because government will, in order to decrease money demand, government will want people to deposit their money, and the only way to attract them in depositing money is by increasing the nominal interest rate. So as nominal interest rate will increase, your money demand will decrease. Money demand will decrease means deposits in bank will increase. Deposits in bank will increase means in order to get money, people will have to make more trips to bank. Now this trips to bank is the cost that you're talking about here. Okay. Now if you go to bank every day or twice a day, then definitely the shoe that you're wearing is going to, it's going to just run off. And this is the shoe leather cost we're talking about. The shoe leather cost is actually your efforts, traveling expenses, or transportation cost. Okay. Now menu cost. Now assume that there's inflation in your country and it is so high that every 30 minutes or every day you're supposed to keep on changing your menu, right? For example, you had idli at rupees 10 today, and tomorrow, since the price is going to increase, it's going to be 15 rupees all of a sudden. Okay, this every day you'll have to print new menu, you have to get it laminated, and this is your menu cost. Okay, now cost of not charging price. It basically means that in case you thought that we cannot afford to spend more on changing menu every day, so you decided not to change it. So now if you are going to keep the same price for all the days and it is constantly increasing, then in place of menu cost you'll actually have to pay the entire inflation tax, right? Or the total impact of inflation on your business will fall onto you. Okay, the Then we have tax distortion. We all know that income tax is filed in basically last period of a financial year. Okay, so and taxes do not take inflation into consideration, which means if you have earned 100 rupees and in 2020 and your income tax was say 30%, okay, you're supposed to pay 30 rupees. But in 2021 inflation rose by 10%, which means the face value of 100 and 110 is going to be same, but you are just paying 30%, which is 30 rupees on this, which is 110 minus 30. Whatever the amount is, it's your loss, because you were supposed to actually get 30% of this much, okay, which is 33 rupees. Pardon this. It's going to be 33 rupees. You lost 3 rupees just because your taxes were not taking inflation into account. Okay, and then we have inconvenience, because if inflation or the prices are constantly rising, then you will definitely face a lot of inconvenience, and this is the fifth social cost that we are talking about over here. Okay, and I also want to clarify, this is social cost of expected inflation. Okay, this inflation is something that we expected to happen. In the next video, we'll talk about social cost of unexpected inflation. Okay, so thank you for now.